Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Author, entrepreneur, and blogger Garth Turner is back with us on This Week in Money. His latest book is Money Road, Tools for the Wild Ride Ahead. And you can always check Garth's interesting blog at greaterfool.ca. Come for the pictures and stay for the content. Garth, it's great to have you back.
Thank you very much, Phil. Pleasure to be on the show.
Let's take a quick spin around our home province here, BC, the canary in the real estate coal mine, and see what's been happening in the moldy city by the sea. Sales down 30% from last year, almost a one-year inventory, Garth. And that obviously means it's a buyer's market here, right?
Well, it does, sort of. Buyer's markets, you have to be careful. Let's go back to the United States in 2005. They had a bull market in real estate which started to disintegrate at the end of 2005. The spring of 2006, sales started to go down and prices melted a little bit. By the end of that year, they were down around 15%. Well, Phil, people said, oh my goodness, prices are 10 to 15% lower. This is a great time to buy. This is a buyer's market. And the people who jumped in at that point got slaughtered because the market went down another 20 to 30 to 40%.
Wow.
So it depended on where you were. Therefore, Phil, you have to be careful. Yes, it's a buyer's market. That's what the real estate guys will tell you because they want you to buy. But I think right now, in many places, it would be trying to catch a falling knife. And I've got grave concern that we're just starting this decline.
Shock for our friends who live back east. The Vancouver average home price just over $1 million, even though it's down 12% since spring.
Yep, single-family home is, I think, $1,053,000 right now in Vancouver, according to the latest numbers. That's down from a little more than 1.2. So yeah, it's 12.25% decline in just a few months since April. That's pretty much in keeping with what I thought was going to happen, but it's just the start. We've seen a similar decline in Toronto in the average single-family detached home in Midtown Toronto. That's gone from about $840 down into the $770 range. So again, it's around a 12% decline. So there is some consistency here in the destruction of these values.
Victoria, Garth, also down 30%. The Greater Victoria real estate sales, they're saying, are slow but steady. And of course, the real estate spin, they're calling it a buyer's market, and they're blaming F for all of this.
Well, there's many things to blame. And certainly the mortgage changes brought in by Flaherty back in the summer, killing off the 30-year mortgage amortization. That is part of it, without a doubt, but it's only one part. We've also had bank regulations tightened up. We've had the end of the cashback mortgage. Banks are no longer allowed to give out free down payments. All of that has had an impact, but even more so in Victoria, Vancouver, and Midtown Toronto has been the decision by Canada Mortgage and Housing Corporation no longer to offer insurance on mortgages for properties selling for more than $1 million. Now that, to most people, they're going to scratch their heads and say, yeah, so what? It's only rich people and they can afford, they don't need mortgage insurance. Well, Phil, it's interesting that right now there are 2,000 properties for sale in Toronto for more than $1 million. There are almost 4,000 in Vancouver for more than $1 million currently on the market, and a similar proportion in Victoria. What does it mean? It means this market is being slaughtered at the top because a lot of people do not put down 20% plus to buy any kind of property, even if it's $1 million. So now you've got a typical $1.3 or $1.4 million house in Vancouver or Toronto. It now takes $350,000 in cash to close the deal. Plus you've got $1 million mortgage, and that has really eaten into the top end.
Seem to remember this stat from your blog from a couple of days ago, Garth. The GTA is 3 times the size of Vancouver, but only has half the number of property sitting around unsold.
Yeah, at $1 million plus, Phil. It's quite astonishing. There is no other city in North America which has the number of listings above $1 million relative to the size of the population that Vancouver has. And as I said in my blog, Toronto's 3 times bigger, half as many properties.
Yeah.
So the disproportionate number in Vancouver over $1 million is just off the charts. And that is why I keep coming back and saying people in Vancouver have no idea how much average prices are going to come down for that city to fall in line with every other major city in the continent. There's always been a premium for living in Vancouver. Yeah. I know, I get it. Mountains, water. Yeah, I get it. So there's a good 10, 15, maybe 20% premium for all that, but not a 200% premium.
Yeah.
And that is why we're only on the precipice.
Garth Turner from GreaterFool.ca, our guest here on This Week in Money. Let's take a look for our friends in Kelowna. The Okanagan sales down 2% last month. Sales year to date, the real estate people are hopeful about this. They say they're up 8%. Market activity, according to OMRAB President Rob Shaw, has been impacted by the tightening of credit. In other words, it's Flaherty's fault.
Well, yeah, that's the average response. Of course, the fault is houses cost too much.
Yeah.
They cost too much in Vancouver, Toronto, Victoria, Calgary, almost everywhere. They cost too much. And that's why they're coming down. People can't afford them. They're tapped out. This is all the debt people are willing to swallow. And therefore, we are in the midst of a real estate correction. Now, the Okanagan is interesting. Kelowna actually has been in a crappy market now for about 3 years. They haven't admitted it until about the last 6 months, but prices have stagnated. They've flatlined, basically, and have been eroding quietly for that period of time. It's a very, very dormant market. It's overbuilt. There are a ton of condos, for example, in Kelowna that have been on the market for 2 years and can't be sold. So it's just not a happy place to be a homeowner right now. And I do think it's going to continue to have that sort of very, very stagnant activity going forward.
Garth, one of the fun things about talking to you is covering the real estate spin on all this stuff. Here's some Kelowna real estate spin for you from the Stone Sisters at stoneteam.com. In 2008, the average price of a single-family home in Kelowna was $550,000. Now it's about $430,000. It has become a more affordable city to live in.
Yeah, unless you happen to be one of the suckers who bought it $550,000.
Yeah.
Now you've lost 20% of your equity. That's no fun. Well, I'm going to go back to my comments of catching a falling knife in Vancouver. Why isn't the knife falling in Kelowna too? Are we on our way to becoming a $350,000 average home price? I think that could well happen over the next couple of years. BC is a great place to live, and I love it, but you got to face facts. The economy, the provincial economy, is not growing very well. The latest job numbers out this past week were pretty good for Canada, but not so hot for British Columbia. We're seeing a net migration of young people out of British Columbia now. That's pretty concerning. You just don't want to see that happening anywhere. But why should young people stay in a province where they know they'll never be able to afford a home once they get married and want a family? So it's kind of suicide by real estate, and BC's got to understand that and get back with the program.
Bottom line here, Garth, across the country, demand is down and listings are up. No wonder prices are down, huh?
Yeah, for sure, and there's more to come. The economy right now is, okay, but it's not generating extra employment income. And our employment situation's a little better. Jobless numbers lately are okay, but still, we've got more than 7% unemployment nationally. We are flatlining with wages, and the average wage and salary increase today is still less than the rate of inflation. And that means that every year people drop back a little bit. So where is the demand coming from? Where is all this extra money that is going to come along and, for example, buy all the 3 million houses that the baby boomers who are thinking about selling, where are those people going to come from? And Phil, this, I just mentioned demographics. It's kind of the elephant in the room. It's estimated that 1/3 of all the boomers in Canada, and there are more than 9 million of us pathetic people, about 1/3 of all those people have to sell their homes. Not that they want to or they're thinking about it. They have to because they have not enough money to survive in their retirement. We are only starting to see the tsunami of new listings which will wash over in the next couple of years.
And still more spin from the real estate guys. The RE/MAX Housing Market Outlook 2013 is out, and they're saying the average price of a Canadian home expected to remain stable and appreciate 1% next year.
Well, be lucky if they see that. I just don't think that's going to happen. I think we're going to see a decline in the average home price across Canada. Certain markets are not going to be much affected where prices are already low. Other markets are going to be substantially affected. But certainly the average home price will be lower next year, not higher. They smoke good stuff at RE/MAX because they're always in a cloud.
Speaking of RE/MAX, here's the final piece of spin from Elton Ash. He's Western Canada Regional Executive VP of RE/MAX. Says there's no denying the universal appeal of bricks and mortar. Canadians believe in home ownership. The stability of real estate over the long term continues to fuel its appeal.
Well, I don't mean to be too critical, and he's right to a certain extent that we have seen that historically. People love real estate. They want real estate. It's a very emotional buy. But when it gets to the point of unaffordability, and certainly when real estate values start going down, this is a wealth trap because it can actually end up as a place that destroys net worth quite quickly. And that's what happened in the United States, and sentiment turned very quickly against real estate. So actually, a couple of years ago, surveys showed us that most people under the age of 30 wanted nothing to do with a house because they'd seen the devastation that it caused to their parents. So these things come and go. Certainly, we've been in a real estate faddish environment for the last 15 or 20 years, and the RE/MAX guys are probably still living in their environment because obviously it's their livelihood. But I think sentiment will change, Phil. I really do. I think more people are going to get it, that having a liquid and balanced and diversified portfolio that's got a lot of different assets in it, not just having all your money in one house, that's the smart way to go.
Garth Turner, our guest here on This Week in Money. You've been talking about REITs, Garth, real estate investment trusts, as long as I have known you. A REIT market has raised almost $500 million this year. This is according to Bloomberg, more than any other industry in Canada.
I like REITs, real estate investment trusts. They're good things to own. And let's not confuse REITs with residential real estate. REITs don't buy houses. They buy apartment buildings sometimes, which do very well when housing markets go down because rents go up and these buildings are always full. So that's good. But mostly REITs buy commercial buildings. They'll buy shopping malls and some industrial plazas, and they'll buy all these office buildings in the downtown cores of cities across Canada. I like them because REITs have cash flow, and they collect rents from all of these clients, these customers. They pass those rents on to the owners of the units of the REITs in terms of distribution. They've done very well, and we've seen an average rate of return somewhere in the neighborhood of 7%.
Not bad.
On good quality Canadian REITs, and those are great. I'm not advocating you take all your money and stick it in a REIT, but having it as part of a diversified portfolio, it's a great little engine to have there.
REIT news starting to heat up here. Loblaw is planning to spin off its real estate into one of Canada's largest REITs. Toronto company is offering $4 billion for the Primaris REIT, and the RioCan REIT, that's another big shopping center one. They're going to buy 5 malls and 3 shopping centers from Primaris for about $1 billion. So lots of movement in the REIT space. Yeah.
Actually, in the last few days, we've seen REIT values just shoot up because of all of this takeover activity and this expansion. I think REITs are good for the long term. Once again, I've got to say, don't put all your eggs in any one basket, but having maybe 10% of your portfolio or a bit more in REITs is great. There are individual REITs to choose, or you can buy a basket of REITs. You can buy an ETF, an exchange traded fund that actually owns all of the major REITs, and that gives you exposure broadly to the sector. That's usually a pretty good way to go for people.
Now, because these things generate interest income from the distributions, probably in a tax-sheltered account would be a best place to have the REIT, right?
Exactly. Yeah. They're great for a TFSA. because they'll be a little bit more volatile than obviously having a preferred share or something that's more boring. But because they do give you the money in terms of distribution, it's taxed as income. So if you hide it inside a REIT, it's great. Of course, you get that tax free. And let's remember, Phil, remind people that as of 2013, the contribution limit for TFSAs is going up. F finally did something right. So we've got it $5,500 will be the maximum contribution for 2013.
You're looking, speaking of 2013, looking ahead to a good year next year. Once all this fiscal cliff craziness is behind us, you're saying the U.S. is going to continue to recover, unemployment will be down, and housing will be up, on the path to a recovery.
Yeah, I believe so. I'm actually pretty optimistic for 2013 and beyond. The U.S. is turning into more of a driver. We've got resale home prices in the U.S. up 6%, 6.2% in the latest period. That's the best showing in 6 years. Unemployment numbers continue to, fall down steadily, slowly but steadily. It's going in the right direction. Corporate profits have been fine. The S&P 500 for 2013 or 2012 is ahead more than 12% right now. So all of that's pretty much pointing in the right direction. The fiscal cliff nonsense is just that. It's nonsense. It's political theater. It will be solved. Nobody should believe for a moment that even if the U.S. goes over this so-called cliff, that there are going to be any long-term consequences. There will not. If this thing doesn't get solved in December, it'll get solved in January. The Americans are not about to commit economic suicide. So I think 2013, really, the stars are lining up quite positively.
Author, blogger, financial advisor, and entrepreneur Garth Turner, our guest. You can find Garth on the web at greaterfool.ca. And don't forget Garth's latest book, Money Road, Tools for the Wild Ride Ahead. A wild ride it's going to be. You owe it to yourself to read this book. It's a good one. Hey, Garth, thanks for talking to us.
Perfect. Thank you. Glad to be on the show.
Coming up, Marin Katusa on This Week in Money.
Always consult your investment professional before making any investment decision.
Randy Elvis Frisky and his Las Vegas show band 40th Anniversary Aloha Tour this January in Chilliwack, Surrey, Sydney, Campbell River, Nanaimo, and Courtney. On sale now. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Marin Katusa is Chief Energy Investment Strategist at Casey Research, and he's Senior Editor of the Casey Energy Report. He is online at caseyresearch.com. Always good to have you back on This Week in Money, Marin.
Always a pleasure.
Your latest Casey Daily Dispatch, it sucks to be ConocoPhillips. Take us to Kazakhstan and the Caspian Sea. What's ConocoPhillips doing there, and why are they talking about getting out?
So let's go back 20 years now when the Iron Curtain fell. The Kashagan and the Tengiz, these were the holy grail at the time of oil deposits. Tens of billions of barrels of oil, the biggest discovery in the last 50 years. And there's been books written about this deposit, about, all of the politics being played between Exxon and Mobil, Conoco, Chevron, how everybody was trying to get access into this area. It was the hottest place to be in the world in the mid-90s. Let's fast forward now to 2012, and since that time, the president of Kazakhstan has extorted billions of dollars from these companies for permits and, behind-the-room payments. Mm-hmm. And what was supposed to come out of the gates at a couple of million barrels a day of production, and the CapEx is now quadrupled, and it's taken, it's going to take a decade longer than they first expected. On top of that, the sulfur levels are much higher than they expected, hence why the CapEx was so high. So Conoco, it's not just Conoco, all of the majors were trying to get into that area at the time, and today it sucks to be ConocoPhillips because of that. So they took a huge hit on it, and what this really shows, Phil, is moving forward, the Exxons, the Chevrons, the Royal Dutch, Conoco, the big hated oil companies, we're seeing that they can't compete with the national oil companies, the ONGCs, the Chinese oil companies, the Indians, because the Indians don't have a problem, the Chinese don't have a problem working with a government like Kazakhstan, whereas Exxon's not allowed to do those types of backroom deals.
You mentioned ONGC, really interesting. They are the company who's buying ConocoPhillips stake. It's a state-run oil company from India, their largest ever acquisition.
Yes, and I actually met with the president and chairman for 3 hours of ONGC while I was in India. And just to put it into perspective, I've been in the boardrooms of Exxon and Chevron and Royal Dutch. I have never seen what I saw with ONGC. It was a boardroom with the biggest table I've ever seen in my life.
Wow.
And a facility where it could fit about 700 people in a room.
Wow.
Okay, so India knows that they have the world's, they're going to have the world's largest population coming up here, and they are starving for energy. They're 10 years behind China. So they're going to start getting aggressive here.
I saw this interesting stat today, Marin. India imports 80% of its oil. It's the world's fourth biggest oil importer. So you can see why they're doing business in places like Kazakhstan.
And the reality, Phil, is these big national oil companies, they need to go where they can move the needle. Okay?
Yeah.
And going into Alberta for 500 barrels a day of production, that's not going to move the needle for them. They need to go to places like Kazakhstan, Iraq, Iran, where they can get tens of thousands of barrels a day because they are starving for not just oil, but natural gas.
You mentioned, Marin, ExxonMobil and Shell. They're also in Kazakhstan. They have to approve the ONGC deal, but probably unlikely that they would do so. I mean, they face the same problems there as ConocoPhillips, right?
Exactly. So what you're going to see is the Americans got in. They're realizing that the national oil companies can compete with the not just the international oil companies, but the Kazakh government is taking more royalties, increasing the taxes, and it's just not profitable anymore for the American oil companies, what I call the international oil companies, where the national oil companies, the ONGCs of the world, they just want the oil.
In fairness to our Kazakh listeners, Marin, we should mention that these kind of problems are basically worldwide. There's a lot of jurisdiction where energy companies are facing problems like they do in Kazakhstan.
100%. And the reality is it happened in Alberta. Look at our energy income trust.
We are talking to Marin Katusa from KCResearch.com. We're going to look at the oil price in a second. But if you really have to pay more at the pump, like it looks like it's going to happen, take a lesson from ConocoPhillips. Figure out how you can make some money here. In this case, you've got a great holiday gift idea, a free trial subscription to KC Energy Dividends. Tell me how this works.
Basically, what we've done is we've recommended companies like Kinder Morgan, which is up over 50%. And what we're trying to get people to do is look at the market and go, be careful where you're putting your money. There's no such thing as risk-free in the stock market right now.
Yeah.
And all we're trying to do is educate people on their investments. Try a 3-month risk-free trial. If you don't like it, hey, it doesn't cost you anything.
KCResearch.com is where you want to check out that holiday offer. Oil in the headlines today, Marin. Energy sector leading market decliners. The economy on people's minds and a stronger dollar. That's sending oil back down to under $88 a barrel today.
Yeah, and the reality is with the fiscal cliff, people are just staying on the sidelines.
Yeah. We also have news that U.S. oil production reached its highest level in nearly 15 years in September. Today, Texas oil output surging to a 24-year high. And that's got to be putting downward pressure on the price, right?
Well, it is, but you see, there's a big difference between what the WTI spot price is and what the companies are getting at the wellhead.
Okay.
That's called the differential. For example, the Canadian oil sands isn't getting $88 per barrel. They're getting about $20 less than that per barrel, because it's all about refining capacity and capacity to the pipelines. Do we move it in the pipeline or do you put it on rail? So it's all about what investors, and I've been saying this for 5 years, it's not about what the spot price is, it's about what your company is selling it for that you're invested in.
Marin Katusa from KC Research here on This Week in Money. And here's a story you know something about. Almost a year after banning fracking for environmental reasons, the UK opening a government office for shale gas.
Well, look, the British have no other choice but to move forward and develop their own national resources. They consume, they depend, they import over a third of the natural gas they use from the Russians. Germany is over 50%. The irony of Europe is they are more dependent on Russian natural resources today than they were 25 years ago. So unless the British plan on developing their own resources, and a company there called Quadrilla has made a fantastic discovery in the Bolan Shales in the UK, which could pretty much provide all of Britain's natural gas demand for the next 100 years. It is a national treasure.
Yeah. UK government making no bones about this, saying that they boosting the shale gas industry, vital to economic growth. They're going to give tax breaks to companies, and they're going to simplify regulations too. So that's a good sign.
It is, but there's only one company there, and that's Quadrilla.
So far, okay. Big energy play today, Marin. Freeport-McMoRan getting back into the oil and gas business in a $20 billion deal. Don't understand this part. $13 billion of that is for a company they spun off 18 years ago for $3 billion. What's the story here?
You know, they're putting just under $7 billion in cash and stock, and they're, you know, it's an interesting. You got Deep Sea Drilling Company there that was spun off 18 years ago that you're talking about.
Yes.
Look, the reality is Freeport's looking at it. They see a lot of problems moving forward in the copper sector because they cannot permit the sector. So what you're trying to basically do is reduce your risk, but you're looking at cash flow per share. And the reality is these assets are solid assets.
So they're basically taking a page from the ConocoPhillips playbook here, are they not?
Well, what they're doing is looking at how can they position themselves for, you know, to not be so dependent on the issues that they've had in Papua New Guinea, which is a world-class deposit, and it's their main deposit, but they've had labor issues there. There's a clash with the locals on the separatist movement. And this is a major company. You know, you look at their interest in Grasberg, which is in Indonesia. That also had some issues. So, you know, Freeport is trying to diversify its risk.
Are we going to see more of the Freeport kind of deals happening in the future?
100%. Because you look at companies where they are trading today. They have not followed where the commodities are at. So if you're a big company, it is cheaper now to go buy out a company like a Copper Mountain than it is to go build a new Copper Mountain. That's just the reality of our markets. So, of course, these big companies like Freeport are going to come around and buy these developed assets because now they're built, they're de-risked, and they're cheaper than you can go and build it yourself today.
Marin Katusa is Chief Energy Investment Strategist at Casey Research. He's online at caseyresearch.com. And don't forget the Casey folks are also on Twitter and they're on Facebook. You can see Marin at the Vancouver Resource Investment Conference coming up next year, January 20th and 21st. You can get info at cambridgehouse.com. That's going to be a fun show, Marin.
It will. It's going to be a lot of fun seeing the Doug Caseys and Rick Rules, myself. We're all going to be giving talks at the show, so it'll be a lot of fun.
Yeah, can't afford to miss something like that. Thanks for your time, Marin. We appreciate it, my friend.
Always a pleasure, Phil.
After the break, John Kaiser on This Week in Money. Randy Elvis Frisky and his Las Vegas show band 40th Anniversary Aloha Tour this January in Chilliwack, Surrey, Sydney, Campbell River, Nanaimo, and Courtney. On sale now. Details at randyelvisfrisky.com.
This Week in Money is archived online at talkdigitalnetwork.com.
John Kaiser is a mining analyst. He has over 25 years' experience. He runs Kaiser Research Online, and you can find him at kaiserbottomfish.com. John, it's great to have you back on This Week in Money.
Phil, it's wonderful to be back.
Hey, it's been about a year since we talked. You got a fascinating piece on the Kaiser blog, something we should be paying attention to this time of year. Bracing for the extinction of 500 juniors or an entire institution. Please check it out. I want to make sure that you see all the wonderful charts that go along with John's article. A real wake-up call, John, for TSX and TSXV retail investors. Market's basically been turned on its head by what you're calling spiders. Who are these spiders, and what's changed in the way these exchanges work?
Well, we've got two factors working here. One is this large concern out there that we are actually heading into a 30s-style depression or severe global recession, which is going to impact metal demand and which, of course, will impact prices, which will mean many of these projects that companies are looking for or are working on to demonstrate their feasibility will prove to be not in the money and, in essence, a bust. In this context of muted market interest where institutional money has withdrawn from the sector because they are very much into the resource feasibility demonstration aspect of the junior sector, we also have a situation where retail investor has remained largely absent since the Great Bre-X betrayal in 1997. Coming against the background of all this are new technological changes, such as the decision by both the American regulators and the Canadian regulators to allow short selling on a downtick and to allow algorithmic programming to be hooked up to the electronic order books. And so what's emerged is a trading culture which is largely divorced from the fundamentals of a company, but very much stalking volatility and working these markets to suck basically the capital out of it. And this is extremely damaging to the junior resource sector, where we're dealing with companies that do not have cash flow, no revenues. They're basically trying to demonstrate that this target is in fact a very valuable deposit once it's been drilled off, or a deposit that they already have is actually feasible to put into production. So there's no real numbers or metrics that the industry can look at to say, well, this company is worth at least this much. It's all based on extrapolations of existing data and projections about future metal prices. And so now this trading culture, they use computer technology to monitor the system, and I call them spiders because it's like a vast web. When you have, trading come into a stock, money come in because some newsletter writer has written something positive, or there's a research report, or even perhaps a news release that's encouraging, they can sense this. They've got their monitoring system there. And I don't think on the Canadian exchange it's so much the computers that do the trading, except in a few isolated instances.
Okay.
But they are used to alert human traders who then scuttle over there and are able to intercept the buy orders that are coming in essence, short sell stock that they do not really own and that they only intend to order, but because they can sell on a downtick when they've exhausted the inflow of new money, they can just lean on the order book and bash things out and create a cascade of selling from the longs who see what looks like a rally and an adjustment to a higher valuation snuffed out once again. And if this sector ever tries to go, gain strength again, this sort of spider trader mentality is going to snuff it out before it can even get going, and that has me worried.
Now, algorithmic trading affects, of course, the big board to a lesser degree, but these are small, fragile companies looking for exploration money. Why are you laying the blame at the feet of the TMX group here? What are they doing to get this going?
The TMX group has a whole range of companies. On the TSX itself, they are substantial companies in the financial sector, in the industrial sector, and also in the mining sector, big producing companies. They also have a number of companies that are more of the junior variety, but most of the junior variety are on the TSX Venture Exchange. And to allow short selling on a downtick basically is very destructive to, I think, they're sort of their golden goose, because they skew the playing field in favor of traders, because it's much easier to make something go down, to break it, than to build it up. And with the emergence of discounted commissions, the brokers who used to serve as important network hubs communicating to investors about what was going on with a company, they are not playing this role anymore. They are now looking just at getting fees on the value of the portfolio. So the less time they actually spend with the customer, the more money they make. So that interface has disappeared, leaving the investors out there to figure stuff out on their own. And because there's also a whole regulatory infrastructure that pretty much forbids companies from monetarily quantifying what it is that they hope to achieve by drilling this target or doing this feasibility work, everybody is on their own to figure out what this is potentially worth. And there's no public repository for posting or filing people's beliefs about what the outcome might be. So when these traders come in there and trash the stock, each person is on his own. And the TSX Venture basically has set things up so that it's a one-sided playing field. And I don't think they're going to change this, because algorithmic trading, high-frequency trading, if they can't sell on a downtick, they will never be in compliance with the old short selling only on an uptick rule. So they're not going to turn the clock back on that. So something else needs to happen to offset this lead blanket that's been laid upon the junior sector.
We're talking to John Kaiser from Kaiser Research Online here on This Week in Money. A bunch of great charts in your article over the blog. One of the most fascinating for me, this chart is showing the juniors themselves. Here's an interesting stat. Since 2005, over 200 Canadian-listed juniors have been taken over. And nearly all of these companies are basically, as you're saying, exploration failures. How's that work?
The last decade, from about 2003 onwards, marked a brand new phase for the junior sector. This was when China's economy really started to come on stream, and demand for raw materials basically exceeded what the mining industry was set up to supply. So we had substantial real increases in the prices of metals. For example, copper going from 60 cents to $4, nickel going from its $2-3 range, trading as high as $25 a pound before settling back. Molybdenum going from $3 a pound to as high as $35 a pound. And what this implied was that the downtrend in real prices that had characterized the 50-year period after World War II had reversed, and we were in an age of new, higher real prices. So during those past 50 years, there had been lots and lots of exploration done around the world, and deposits were discovered, but the grade wasn't sufficient or the location wasn't right to put these into production. So anything that doesn't go into production is technically a failure, yet it is still an asset that has been created by the risk capital of past exploration cycles. And what happened was when the industry realized that there was a serious change afoot, and the mining companies themselves didn't figure it out until 2006, but the junior resource guys did. So they found all these deposits and got them out of the private sector, put them into public shelves, and then turned to the institutional market and said, hey, when we crunch the numbers in terms of these new super cycle China-driven prices, this stuff is economic. And most of that takeover activity that we saw there was bigger companies absorbing these deposits that the juniors had dragged out of the woodwork and upgraded through resource feasibility demonstration work. And this was phenomenal because the technical expertise that helped this happen really upgraded the talent pool within the junior sector, which in the 80s and 90s was restricted largely to generating targets and drilling them, and if you found something really good, a major swooped in, took it over, and carried it on from there.
We are talking to John Kaiser on This Week in Money. We have been talking all year long about copper, silver, and gold prices. They're near record levels. Mining stocks, we've been kind of scratching our heads. They're not doing so well, and wondering why. You're saying it's caused by something called the mining sector inflation rate. What happens here?
Well, part of the whole sort of China-driven demand for raw materials also increased the price of these raw materials as well as the technical expertise to create the equipment or to put these things into production. And the disturbing thing that's bothered everybody is that since about 2008, 2009, there's been sort of a catch-up inflation in the mine development sector. So capital costs and operating costs are estimated to have increased about 10% annually in the last 4 to 5 years compared to the 2 to 3% CPI that's official for the general inflation index. And so even if you inflation adjust metal prices from, say, 1980 onward, that gives you maybe a price like $3 copper. But if from 2008 on you suddenly add 10% per year, what looked like a real price gain for the metals has actually been gobbled up by the especially high inflation rate for the mining sector. I think this has probably stabilized right now, and going forward, I do not think we'll see the same level of a mining cost escalation. But that has definitely dampened the enthusiasm for the market as they see the feasibility studies come in with much higher capital costs than ever imagined, much higher operating costs, and coupled with this general anxiety that we are heading into a recession, we're going to see lower metal prices, the market has been inclined to discount the prices of these companies by plugging in lower metal prices combined with these higher capital and operating costs, which produces considerably lower valuations than if you were to plug in the actual metal prices that we are seeing these days.
John, speaking of anxiety, we're starting to realize the fiscal cliff is more of what Steve Forbes calls a fiscal pothole. Once we realize that and wake up, you're saying we're going to see a whole lot more merger and acquisition activity in the junior resource space.
Yes. With regards to the fiscal cliff, it's better to describe it as a fiscal slope because it's not like on January 1st anything changes.
Yeah.
What changes is as far as capital gains and the tax that you pay a year and 3 months later in April 2014, that's going to be higher. For payroll taxes and that the people who are just ordinary income earners, they will immediately have $200 or $300 less a month to buy their groceries and so on. But that itself is not going to have a major impact. It's the cutbacks in, say, the defense budget and other services which could have a multiplier effect in the economy, which could put the United States economy into an austerity-driven downturn. And that would be very bad because if this actually did happen, then we would see Europe continue to limp along and have no chance of recovery, and the Chinese slowdown stabilization and going forward, that would also be hurt. So it's actually quite critical for the U.S. economy to start trending upwards. I think we'll be surprised. We'll see that the manufacturing renaissance is back on track after the industry spent 18 months sort of holding off so that they could throw the election in favor of the Republican Party. And once we start seeing that the light at the end of the tunnel is no longer shrinking, then there will be this collective acceptance in the mining industry, in the markets, that metal prices are not going down. We're not going into a depression. And when that happens, rather than plugging $1,200 gold into cash flow models, they'll plug in $1,700 gold. They'll plug in $3.50 copper rather than $2 copper. And then there will be a wave of mergers and acquisitions by the big guys, taking out all the best of the advanced companies, of which there's about 400 companies that have advanced pre-production projects. And that wave comes from simply a glass going from half empty to half full. And when it kicks in, I think it'll be quite violent and will catch this market off guard.
John Kaiser's blog post is called Bracing for the Extinction of 500 Juniors or an Entire Institution. It's at kaiserbottomfish.com. John, a great Christmas gift will probably be a trial membership. We need information. Tell me how I can get access to Kaiser Research online.
It's very simple. You do a first-time registration. I recommend people do the $100 trial, which is good for until the end of the first full month. It gives you access to our search engine, which is, I think, very timely right now. Mm-hmm. You can find out which companies have money, which companies have gold deposits, how many shares they have out. And we've also published our bottom fish list in July, anticipating that we would have a little bump in September, which we did, and then a fall off right now in the December period. So we've already flagged just over 100 companies, which we would think would be the survivors, not on that list of 500 companies which have less than $200,000 in their treasury and no real means of raising anything in the current market climate. And then, of course, you also get my commentaries, company-specific commentaries, explaining which ones are my best picks and what needs to happen to make some very substantial scores, especially if I'm right about we're heading into a discovery exploration market where it's back to the Arequipas and the Virginia Golds and the Aurelians, where you make 10, 20, 30 times your money rather than the 100, 200, 300% you might make from speculating on advanced gold projects.
KaiserBottomfish.com is where you want to go. John Kaiser is there. You'll also run into him at the Vancouver Resource Investment Conference. That's coming up January 20th and 21st next year.
That's right, and we have all those companies tagged in the site. So if you're going to this conference and you have a membership, you can click on the companies that are going to be there and start searching for the diamonds in the rough that are going to be in that at that conference.
John Kaiser, good to talk. Thank you, sir.
Thank you, Phil.
Thanks to our guests, Garth Turner, Marin Katusa, and John Kaiser. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.